Talking about equity, very important. Equity is any instrument, any contract, you can say, contract with residual interest, with residual interest. Okay. Also, I would say it has residual interest, no priority payments, no priority. Last privilege is given. Last privilege is given. Okay, last privilege for repayments. It is subordinate to all other instruments. Okay, you can also say these are the ordinary shares. These are the ordinary shares. Okay, these are the ordinary shares. For example, if we talk about any company, equity shareholders are the ultimate risk bearers, are the ultimate reward. I would say rewards will also be encashed by the owners. Equity shareholders are considered as owners. They are the ultimate, I would say, people who will encash all the risk and rewards, who have to bear all the risk, who will encash all the rewards. For example, if we talk about any liquidation scenario, there is a company which goes into liquidation process, bankruptcy process, then what happens? A liquidator is appointed and it takes care of all the assets and liabilities. It makes sure all the assets are sold off, auctioned off, and well amount is I would say recovered, collected, and simultaneously the liabilities of the entity are paid off. Liquidator is appointed. Now, as an entity, as a company's point of view, you are required to pay liquidators fees firstly. Secondly, you will be required to pay all the secured creditors, all the secured, I would say, loan providers. Then all the unsecured loans will be paid off. Then finally, preference share capital will be paid off. Then afterwards, in case if any surplus is remaining, then that will be paid off to the equity shareholders. Equity shareholders therefore have residual interest in the last, in case if there is any surplus, that will be distributed to equity shareholders. They are not given any preference over any other class of instrument. They have residual interest. They are not given any priority on payments. They are given the last privilege for repayments. They are subordinate to all. They are simply the ordinary equity shares. Is it clear? Now, simply just to understand, it is not part of the definition, but in case if they do not attract, if they do not attract any, if they do not attract any mandatory obligation, equity shareholders do not attract that they have to be paid this and this dividend. This, they are not promised for any dividends or any other base amount repayments. Okay, they do not attract any mandatory obligation to repay. Whereas the major difference between financial liability and equity is that both are payables. Definitely, both have borrowed the amounts from the investors and that has to be paid back. But in case of financial liability, there is a mandatory compulsory obligation to make repayments in time. Whereas for equity, there is no mandatory obligation to repay. It depends upon the situation. You're not bound to repay. You're not obligated to repay. Give me a